One of the most important math processes that you're going to go through in your career is determining how much house payment your borrowers can afford. So you need to remember, depending on your programs, your acceptable debt to income ratios for the loan program, not just housing, but also total. So both numbers need to be applicable to your particular borrower's situation. So what we're going to do in this section is we're going to be solving the equations for both the front and back end debt ratios. So let's talk about the front end debt ratio. To determine ratios, what you need to do is you need to multiply the gross monthly income by that particular ratio that you're trying to hit. So in this case, let's figure this thing out. So if you're doing a conventional loan, 28% is the regular, normal, customary front end or housing ratio. Other programs will have different ratios, like for example, FHA will have a 31% housing ratio. And I note that VA loans do not have a front-end debt ratio. So you have to look at the programs, and determining the programs will determine the different ratios that you're trying to hit. Okay, so let's assume a borrower makes $6,000 per month. So the maximum housing ratio, if you were going to go conventional and government, conventional, 6,000 times 0.28 to determine 28% is $1,680. If you were going to go FHA, same 6,000 gross monthly income times 0.31, okay, or 31% is $1,860. Okay, so you have a rough idea of what the ratio or how much the borrower can afford. So now let's understand the back-end debt ratio, also known as the total debt to income ratio or total DTI ratio. Now again, let's assume that the borrower has $580 in monthly debts. For conventionally underwritten loans, the conforming DTI ratio for back end is 36% of the borrower's gross monthly income. Now remember, this monthly debt also would include the borrower's house payment. So if we use the same $6,000 again, times 36%, we have a total number of $2,160. That's our total DTI. The borrower's total debts cannot exceed $2,160. Now, what we're going to do is we're going to subtract the debts that they have. Maybe it's a credit card, a car payment, student loan, something. We're going to subtract the $580. So what that does is it lessens the amount that the person can have in a house payment. So now we went from before, if you guys remember, before we were at $1,680. We're now to $1,580. So you can now see that even though the borrower could have afforded a more expensive house payment, because of debts, their purchasing ability is reduced. Now again, some mortgage programs such as VA loans for veterans don't have a front-end debt ratio and only look at a back-end or total DTI. Using the same monthly income, $6,000, and the same debt, $5,800. Let's see the differences in the programs. All right, so a program may go up to a 43% back-end DTI if a borrower meets certain loan guidelines, or it could even go a little bit higher. So let's take our $6,000. We're going to multiply it by 0.43 to get 43%, and that 43% is $2,580. Still have the same debts. So we're going to subtract $580 in debts, and the borrower now qualifies for a $2,000 a month housing payment. Do you see the difference? We went from $1,580 to $2,000, but then again, it's VA and not everybody's a veteran, okay? So loans that exceed 43% may be considered non-qualifying mortgages or non-QM loans. The allowable DTI will change based on the loan program. So if the borrower meets all the program requirements and receives an automated underwriting system approval or an AUS approval, what is the maximum monthly payment the borrower can afford? Okay, well, it depends. Did you go automated, AUS, or was it a manually underwritten program? DU or LP underwriting at $6,000 times, say you go not 43, not 44, but 45%, now you're cruising at $2,700. Subtract the $580 in debts, you've now got $2,120 allowed for mortgage payment. So did you get that? Depending on the program, depending on DTI, depending on how much debt, all of those play a factor in how much that borrower qualifies for. So, you have a borrower that has 3 Mercedes and 2 Maseratis and a boat, and they're trying to buy a house and they're making $10,000 a month. That may all be well and good, but they might only be able to afford a $1,000 or $1,500 a month payment, house payment, depending on the debts that they have. Okay. So, and another thing you need to consider, was the loan submitted through an automated underwriting system, or was it submitted, to a person, a human being that could look at some things outside of the box and then determine, does the borrower not qualify? Do you want your decision, if it was you, the home buyer, do you want your decision to be made on a software program or by a living, breathing human being that could take into consideration some things that a computer software program could not? So it's essential for you, as you're visiting with the borrower, and maybe if it's a purchase, maybe even with a realtor, to determine, does the borrower pre-qualify for a loan? And if it's a purchase, you might be looking at a pre-approval. You need to check to make sure that the borrower qualifies for the loan program and meets all of the requirements. So FHA may allow you to expand ratios with compensating factors that we'll talk about a little later on. So just on the examples that we gave you, just on the examples that we talked about, just on the person making $6,000 a month, these examples show a range of house payment that the borrower may qualify for. 1, under program. 2, is there even a front-end debt ratio? 3, is it automated or manual underwrite, right? So all of these things play a part in determining whether their income is sufficient to cover that house payment. So if I remember correctly, on the low end, we were looking at $1,580, and on the high end, we were looking at $2,120. Oh my goodness, there's hundreds and hundreds of dollars of difference between the $1,500 and the $2,100, okay, which could be a significant difference in the price of a home mortgage that your borrower qualifies for. So everything that we do in our calculations is always on the loan amount. Yes, we take purchase price into consideration. Yes, we take down payments into consideration. But this video section that we just covered deals with how much of a mortgage, how much of a loan amount the borrower qualifies for. So if you're thinking, well, I'm just going to put everybody under a VA loan. Well, again, unless they're a veteran, they don't fall under those guidelines. Most of the time, it will be FHA or conventional. Most of the time will be FHA and conventional. And then you also have to look at, besides principal and interest, all of the other things that might be involved in the payment. So you're thinking, well, okay, FHA gives me a greater housing and back-end debt-to-income ratio, or DTI. Okay, but there's some gotchas with FHA. Well, Dave, I think conventional is easier. I think it's a little bit more, I think it's a little bit less of a down payment. I think it might be a better, easier program or process to go through. And you might be right, it might. But then again, depending on the down payment, do you have mortgage insurance? Well, FHA's got mortgage insurance, but FHA's mortgage insurance is for the life of the loan. FHA might require a slightly higher down payment at 3.5% over conventional 3%. So you have to look at the program and all the requirements of the program, and also look at compensating factors with, FHA will give you a little bit more in ratios with compensating factors than conventional programs from Fannie and Freddie. You're just going to have to look at the options. Then you're going to have to make a determination. Then you're going to share those ideas with your borrower. And then ultimately the borrower is the one that's going to have to make the decision as to what's best for them and their family. Remember, they're the ones that make the monthly payment.